Hey guys, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno from Real Vision, sending to you live the 22nd of August. On another day of absolute mayhem in energy markets. So, in the light of that ongoing turbulence in energy markets, we've decided to ask the question today: when will the energy crisis end? And I have invited the global markets editor from Real Vision, Weston Nakamura, to join me for a discussion on that exact topic. Weston, it's good to see you again. How are you?
Great to see you, Jess. How are you?
Good. I mean, we've basically got most of the energy importing world represented here today, Weston, with Japan and Europe being in the same virtual room. But before we get to that discussion on the energy crisis, let's just have a sort of brief top-down assessment of the market moves we've seen across assets today. It seems as if energy is in the driver's seat.
Yeah, certainly. Especially in your neck of the woods. With Germany hitting 700 on that level on power. If you want to get into that.
Yeah, I mean, crazy move. I think we can bring up a chart on France, actually. Germany is also very interesting from an electricity perspective. But if you bring up the chart, Brian, on the French pricing of electricity into the winter, we basically reached new levels in the pricing of the December contract for electricity in France at above 2,500 euros per megawatt hour for the peak load. So basically the hours during the day where you use the most electricity. Quite an interesting move today in energy across the board as a consequence of this move in electricity and natural gas. Weston, we've seen spillovers to the FX space, and I think last time the two of us debated on Real Vision Daily Briefing, we had a discussion on whether the euro was a good short. I think we agreed at the time that it was a good short, but the debate was against which currency to short it. So what should take right now, given what we see in European energy markets?
Yeah, actually, no. So what you and I were. So last time it was just you and I. This was the day before July FOMC. So heading into July FOMC, and it wasn't actually a USD or Euro short. What we were doing was talking about JPY long, given the very crowded short JPY position, and if there would be any hint of I don't want to say dovishness, but slightly less hawkishness coming out of perceived come out of the FOMC, you may see an enormous amount of profit taking and closing of this position of policy divergence between the U.S. and Japan, which is what the long USD JPY trade was. But what I was saying then was instead of shorting USD JPY, you go long the yen against the euro, so you short EUR JPY. And there were several reasons for it. One of the kind of bigger fundamental one being that it was my belief at the time that with the ECB having just rolled out their yield spread control program, they're looking more so like the Bank of Japan rather than they are the Fed, even with ECB's front-loaded rate hike. Should the market realize that the risk that you had actually brought up at that time was for being long the yen was that was this very energy crisis that was hitting globally, and if energy prices continue to skyrocket, and Japan is a massive importer of not just energy but of just raw materials and basically everything, right? And so that can be a huge downside risk for JPY if you're going to be long. But the reason that I was saying that's why you short the euro against the yen is because by shorting the euro against the yen, it's my belief that so Japan has definitely has issues in terms of procuring energy imports. However, they're not nearly as bad as Europe. And so it's very hard for me to imagine a scenario going into at least the second half of this year in which, in terms of specifically that front, that energy import risk, that whatever headwinds Japan might be facing on that front, Europe has to be worse. And so therefore, a short EUR JPY trade almost has that built-in hedge regarding that specific risk parameter. And so that's why you short EUR JPY. And also because of, Brian, if you bring up chart 1, you'll see that this was kind of intraday today. We hit parity again for Euro USD. very, very pesky to really break below that. That's this is like what is it, like a second or third time that this year that it's attempted to, and it's not really meaningfully doing so. However, against the yen, there's plenty of air underneath there, and so that's you don't really have to deal with like this very stubborn Euro USD parity like floor, nor do you have to necessarily deal with the USD strength that will bring dollar yen higher if you're trying to go long the yen. So basically, you just take the dollar out of the equation, and you're left with shorting the euro against a very oversold yen. And so that's kind of the trade. The bottom part of that, by the way, is where you and I had that discussion about going into the FOMC about shorting euro JPY or being long JPY, and it's been the better of the shorts of those three pairs.
It definitely has. I made a threat earlier today on Twitter saying that if euro versus dollar hits 0.95, then I will open an OnlyFans account. So fingers crossed that we don't reach that point now, because I don't think anyone will like that scenario. But by the end of the day, let's get back to the discussion on the actual stuff you're going. Yeah, go ahead.
Let me just. I because I was thinking about this right before we came on, and your threat that you put out there. But A, please, for the love of God, Europe, get your act together so that this doesn't happen. And B, maybe, I don't know if this is like an American sort of, term or whatever, but when people say they lost their shirts shorting the euro, I don't think that this is exactly what they were talking about. So just wanted to make that clear in case you weren't clear. But yes, let's move on, and let's hope that the euro doesn't break too far below parity.
Yeah, so one reason why I actually think that the euro will gain a little bit of support over the coming month or so in terms of the move against the dollar is that we actually see a very decent building of gas storages in Europe right now. And I think, Brian, you can bring up a chart on the running flow of natural gas into Germany right now. And I think it's quite underreported that Germany's gas flow is actually very, very strong right now. They're just paying a lot for the gas, but the flow is strong, in sharp contrast to sort of the general opinion. So I think the issue in terms of capacity has been more or less solved by now, but at a very, very high cost. So that's sort of the next thing to deal with for politicians, how to ensure that households and corporates will not face the entire cost. And if we get to that stage, I actually think that the euro could stage a comeback. But right now, the market is certainly thinking otherwise. But Weston, if we look broadly across the FX space, then I can bring up a chart also on the positioning. You've mentioned the positioning in yen already. And if we look at the most recent data print for the CFTC futures, then we can see that there is a negative net open interest in JPY at around 22% of the open interest. So basically still a big short in the Japanese yen. Do you think the yen will basically have legs given this positioning still?
The short yen, so long USD JPY?
No, so the long yen story, given that the market is short.
The long yen. Yeah. So I mean, it depends. So again, so you're going to Jackson Hole. I'm assuming that Mr. Powell and friends, they cannot at all seem slightly less hawkish. I'm not going to use the term dovish, but just like slightly less hawkish. Otherwise, I mean, what the hell are they doing there, right? So, so you're probably going to see, against the dollar at least, yen downside, at least going into that in expectations, if not coming out of that, like having expectations that were for a more dovish pivot sort of language to come out. Either way, though, you're probably going to see going into it or coming right out of it in the very near term, in the immediate, this week, you're probably going to see yen to drop further, or dollar yen to rise further. But again, this is why I just don't want to touch the dollar at all, and so this is why shorting the euro yen cross rate, you can have a situation in which, like the chart you were showing, this previous chart you were showing with European energy. I mean, that's against euro USD play, and again, you could just remove those sort of factors from it, and you can just strictly kind of look at almost policy divergence between BOJ, ECB, perceived policy divergence without this like parity psychological floor. It's not a psychological floor; it's an actual floor, as we can see, and these other factors as well. And again, the risk to Japan is going to be less than it is for Europe, and so therefore shorting the euro against the yen could be a way to sidestep all of that.
Yeah, I think that trade makes a ton of sense still. Also, given that the positioning is still very heavy in the US dollar on the long side, at least if we watch the CFTC data. I know that you have a point to make in terms of the price action in the Chinese renminbi as well, Weston, because it seems as if it is an important gauge for risk assessment overall.
Yeah. So I'd say over the last about 2 weeks or so, the focus really should have been for global cross-asset, market participants to keep a very close eye on China, and that is expressed through and reflected via the USD CNY or CNH cross. CNH is the offshore yuan. But basically, so this is kind of the timeline event. So basically, Wednesday, August 10th, right? PBOC they have a quarterly monetary policy report, and they were showing that like their concern was inflation. They were being hawkish, right? That was kind of strange. They were saying like there's structural inflation pressures and all that, and so we can't lower our guards, is what they were saying, and so therefore, I think it was literally zero surveyed economists predicted any sort of near-term rate cut by the PBOC. So that was the 10th of August. The following Monday, so last Monday, August 15th, PBOC shocks the markets and the world by cutting 1-year MLF rates by 10 basis points and then 7-day reverse repo rates by 10 basis points. And they did that 15 minutes before a slew of horrendously shitty data that came out, right? So you had July, industrial production was missed by, I think it was 3.8% versus 4.5%. You had retail sales that came in terrible for July. Fixed asset investment, property investment, youth unemployment, as you pointed out recently, hitting above 20% and all that, right? You have Goldman cut China growth forecast for this year for the second time this month, down to 3%. There's others that are saying like China growth is going to be in the 2 handle. And you can't really say that if you're on the sell side because you're going to be kicked out of China. But those who are not those who are on the buy side are looking at 2-handle China. So all of that's happening, right? And so PBOC does a reverse, like a sudden reverse, and they shock cut rates 15 minutes before all this came out. And that was a significant moment because that was the moment that marked kind of the top of this recent risk asset rally, this broad-based risk asset rally, be it SPX or BTC or whatever, because CNY and risk assets began to correlate to the downside with CNY or USD CNY inverse, right? So you have like USD CNY rising, I think the sharpest in I think over a year. NDX was down 2.5%. On the week following 15% rally off of lows, and when that stuff happens, you just hear like general comments like, oh, it's about time like this bull market rally would be over. Nobody ever gives like a specific market reason. This is a specific market reason, okay? Last Friday, August 19th, into the weekend, okay? Brian, can you pull up chart 2, please? I will walk you through exactly what I'm talking about. 9:15 a.m. in China, in Hong Kong, China, okay? So basically, 9:15 a.m. is 15 minutes before China equity open, and that's the time that the PBOC sets its daily yuan fixing. They set it to above 6.8, which is a very psychologically key level. It's the weakest level since September 2020. And when they did that, risk assets, and that's because risk assets and yuan are correlated, BTC took its first of 2 major intraday drops, like, I don't know, 90 seconds later. And yeah, so that's reflected in chart 2. And then later that day, that same Friday, with about 16 or so minutes left until China and Hong Kong market close, which is 3 a.m. US, 7 a.m. London. Okay, so that window of time is like Asia activity, predominant, right? That window of time. That's when you saw a huge BTC and risk asset liquidation. as there was no meaningful market supportive policy that was coming out of China or perceived to be coming out of China, and traders were dumping risk, before going into the weekend. Now, notice in the same chart, during like weekend trading hours, BTC doesn't actually do anything. It's relatively flat. It only moves when traditional markets move, and traditional markets are currently driven by the yuan at the moment. So over the past, since the top of this bear market rally, whatever you want to call it, this risk rally, that was marked by the top of this flip in China, and perceived inability for Chinese policymakers to sort of save markets, if not the broader economy, and things are just kind of getting worse and worse. Then yesterday, China cuts its 1-year LPR by a very meaningless 5 basis points, cuts 5-year LPR, which is targeted at like mortgage rates, right, by 15 basis points. So what they're trying to do is they're trying to signal mortgage and property sector concerns and support of that. Bloomberg's reporting a $29 billion bailout of the property sector from authorities. But either way, yuan starts breaking down, going into this session, taking down equities as USD-CNY is well above the 6.8 handle to a new year-to-day high, hit last on May 15th. And then, Brian, can you just pull up this final chart, this chart 3? I just want to show this USD-CNY like year-to-date timeline. Okay, so basically, April 20th is a significant day. Okay, before April 20th, for like multi-year, basically for maybe like 2 years though, USD-CNY, which is a managed currency that managed every day, they set the fix every day. That was in a very stable, like plus or minus 2% range or so for years and years. Okay. On April 20 of 2022, the Bank of Japan begins to pre-announce consecutive day fixed rate JGB buying operations. In other words, they're offering to buy unlimited JGBs, and that leads into them doing that forever and guaranteeing that forever instead of on a day-to-day basis. So April 20th was the last day that people had any sort of uncertainty of what the BOJ would or would not do in terms of supporting the JGB market. And when that happened, that triggered USD-CNY for a 7.5% surge in the course of about 19 trading days. Years, it was flat and around 2% plus or minus, 7.5% surge within 1 month. And then that surge ends on May 15th when the IMF increased the weighting of the yuan in their basket. CNY reverses or stabilizes until now. And then just the past few hours ago, you saw USD-CNY break through that March 15th level. And so now we're kind of in almost a free fall. And if we see like USD-CNY up to 7, I mean, you're looking at significant sharp downsides day after day after day coming in for SPX, for the DAX, for Euro stocks, for Bitcoin, for the Nikkei, for risk assets, for commodities, and all that too. So very important to keep an eye on.
Weston, if we assume that the Federal Reserve will sort of remain hawkish at Jackson Hole, and at the same time we see at least small rate cuts in China, will dollar versus the CNY then turn into the new dollar-yen trade on the policy divergence front?
Yeah, I mean, in a way, yeah, because from a policy divergence stance, yes, except for. It's a very interesting question because it's one of them. So China is basically doing that, but they're doing it directly by managing the currency, whereas the Bank of Japan is doing it indirectly by managing their JGB rate market. So I guess it's like manipulation by direct form or indirect form. But yeah, I guess in concept it is, yeah.
In relation to this debate on Asian currencies, I wanted to play a soundbite for you. It's from a discussion between Brent Johnson and Francis Hunt on the Hong Kong dollar peg and whether it's at risk of depegging versus the dollar as a consequence of all the turmoil that we see in both Japanese markets and Chinese markets. So let's listen to the soundbite and get back to that discussion.
For people who aren't as familiar watching currencies and what can potentially happen, we saw the yen earlier this year lose a lot of value, and it did it in a very steady manner over a number of months. That is not possible with a currency peg.
Correct.
You will see the currency peg stay flat for a long time, and then it will just disappear, and you will see a massive move very quickly. It was able to happen that way on the yen because there was no currency peg. But if we're talking about the Hong Kong dollar, The fact that it's sitting right at its band level for a very long time shows that without the band, it would be doing exactly what the yen did earlier this year. But it's the peg that keeps it flat. Anyway, back to you.
No, I love that. And I refer to it as the dam wall breaking scenario. You either let a river run and it trickles on, as the yen did, or you dam it up and you hold it artificially at a level. But at the end of the day, it's going to the sea, and it goes a whole bunch faster, a whole bunch quicker when you do the dam wall, because the dam wall breaks and then the pressure's too much. So it's a very, very valid point. And I would further to add to Brent's point saying the longer they disproportionately hold a mispriced and they don't let markets pricing mechanisms work, the greater the subsequent move. Now, don't forget, this has been a 40-year peg, but the pressure really is coming on now. So it just becomes they store up a bigger move because they'll have less resources, they'll be leaner, and there'll be complete capitulation.
The entire discussion between Brett Johnson and Francis Hunt is available for essential subscribers to the Real Vision platform already. Weston, back to you. I mean, this discussion on the Hong Kong dollar peg has been ongoing for at least as far as I can remember, the past decade or so. And it's been a favorite trade for many hedge funds to try and depeg the Hong Kong dollar versus the US dollar. But given the market developments that we see right now in China and Japan, would you see a risk of this Hong Kong dollar peg depegging over the course of the next year or so?
I don't know, to tell you the truth. If I look, coin toss 51.49, no. Would be my guess. But what I will make a comment on, though, with regards to what Brent Johnson was saying about how, like, so the yen is, Japan is an open economy, open markets, and so on and so forth, developed markets, blah, blah, blah. And so therefore, dollar yen or the yen against whatever is a free floating currency. It's set by market rates and all of that. That's true. And so, his point about that's why you saw this huge move with the yen, and you're seeing HKD instead, like, just basically like a dam about to burst, kind of just like at this limit in which the peg is being enforced, whereas the Japanese currency is not doing that, and that's why it's allowed to fall. Yeah, that may be. However, if you look at 10-year JGBs at its 25 basis point ceiling, that is also a peg that is being artificially enforced by a central bank dam. And if and when that explodes, this was my whole point about flagging BOJ since the beginning of this year, that is very much a peg as well. It doesn't matter if it comes in currency form or if it comes in a major sovereign country yield being artificially kept. When they're right up against an artificial level, it means that is not the fair market value. The fair market value is being suppressed. And if you let any sort of give happen, you're going to see an explosion of cross-asset explosion and this huge mess. And so that's why I was and still am, going to be very focused anytime 20 or 10-year JGBs hit 25 basis points, and people should be very concerned about the Hong Kong dollar also right up against the edge of this peg as well as like other managed currencies like the yuan as well, right? Because if markets are, let's say, self-perceived that they can win against a central bank, they will really try to push it, and sometimes they might be able to break it. It might be a Bank of England Soros situation, but from what I've seen, like a lot of time, most of these like markets versus central banks fights, at least like in these smaller battles, not the war, but the smaller battles, they tend to lose. The market participants tend to lose. So I don't know. I mean, one of these days they can win and be the heroes that beat the central bank. But I think George Soros was more, and the Bank of England was more so an anomaly and not really a free markets will win at the end of the day sort of thing. Now, I think that people that like have the printing press or have unlimited reserves, unlike the Bank of England back in the 90s, they will be able to at least persevere to get to the next sort of like safety point at least.
Yeah, and you're obviously right, Weston, that when you have a peg in the FX, as you have in Hong Kong, the moving part is the interest rate. So we've seen a massive spike in the short end interest rates in Hong Kong through various market disturbances in Hong Kong when the peg is very close to its borders. But we get a lot of feedback from the audience on the Real Vision page and on YouTube and on Twitter. So I wanted to pass on a few questions to you, Weston, in relation to our debate. Tim is asking us for the perfect trade given all of the information that we've presented today. So, I mean, ahead of Jackson Hole, with the knowledge that we now have around the CNY being sort of a gauge of the risk assessment, what's the perfect trade? Do you have a view on that, Weston?
I'd never heard of something called a perfect trade before, or I don't know. There is no such thing as a perfect trade. A trade, however, a coin toss that you can risk manage into not losing money, perhaps, might be a better way to think about it, would be... so the thing is that people can't really, I guess, like, a lot of people can't really trade the yuan necessarily directly, per se. But I would bet on further policy divergence from you. Okay, you could do it this way. You could still, I think that you could, there's still, like, in terms of a very short term, if you want like a very short term kind of speculative move, you can short the yuan. It's very difficult to do unless you're kind of institutional, or you can short the yen against the dollar, because you'll probably see, although again, spot dollar yen is now reaching towards 140 level. It's obviously much more attractive when it's closer down to like the lower 130s, but there might be like a pop there on a Powell comment. But again, there isn't really even like a press conference thing, so there's no real sort of speculative jolt with like a lot of like algos like kind of lined up and like with futures like ammoed, like a full magazine of futures ready to like blast through the market. So, yeah. So a long-winded way of saying, no idea.
I think the trade that I have the most sort of confidence in right now is to be long the S&P 500 versus being short the DAX. So the German main index in equities. And I think the trade works simply due to the fact that you have a bigger energy crisis ongoing in Europe, and you have a spike in inflation in Europe relative to the US, which will likely allow the European Central Bank to be more hawkish over time than the Federal Reserve, even if they have this yield curve control in place. I think they will simply be forced into rate hikes during the fourth quarter as a consequence of this massively rising energy sector in terms of the price pressures across the board in Europe. I also think that we can bring up a few charts on the relative pricing of the Federal Reserve and a few of the European central banks, because this is interesting in relation to this ongoing energy debate, Brian. So if you bring up the chart on sulfur pricing in the US, and then after that, the Sonia pricing in the UK, actually now the market is more hawkish in its future projections for the Bank of England relative to the Federal Reserve when it comes to sort of the terminal rate being priced in to markets. That's pretty interesting because that certainly wasn't the case like 2 to 3 months ago. So for now, the market is clearly trading that the energy issue in Europe will grow bigger during the fourth quarter, and it will ultimately lead European central banks to hike interest rates even more. And I cannot see that as a positive scenario for local equity markets, since inflation is up and central banks will have to turn hawkish as a consequence relative to what we see in the US. So that's my perfect trade, if I'm allowed to say so, being long the S&P 500 versus being short the DAX. Heading into this, yeah.
I kind of just thought, look, I gave about literally, you could just go back and time it, about 3.5 seconds of thought of this. Shorting AUD JPY.
Yeah. So the Aussie dollar.
That would be a shot.
Yeah.
Yeah.
Good idea. I tend to think that that it's a fair assessment.
Short term, yeah.
Weston, if we look towards the rest of the week, Jackson Hole commences on Thursday. We have a lot of questions on whether we have sort of a potential for a bounce if the Federal Reserve is dovish at that conference. So what's your assessment of sort of the risk assets into this, given the sell-off that we've seen today?
So again, it depends on how dovish they are. And look, I don't want to use the term dovish. I would just want to use the term less hawkish. But if they're full out dovish, as in like we're going to cut rates and provide liquidity, well, that would actually probably be a knee jerk upside to markets and then followed by a crash, because like markets are going to start thinking that CPI in the United States is going to hit like 40% or whatever. But I would think that still the current driver is not necessarily the FOMC, and not because they don't matter or anything like that, but because of many reasons. One of which that there's a ton of uncertainty with what the FOMC is going to do, which the FOMC themselves are shrouded in uncertainty about what they themselves are going to do. So, however, China is deteriorating on many fronts. And so there are, and you see the currencies just now breaking out. USD CNY is breaking out, therefore CNY is breaking down. So many issues. You have COVID outbreaks, you have the zero COVID policy, you have these record heat waves, you have droughts, you have power shortages that cuts, that makes for industrial production cuts and all that kind of stuff. You have people not paying their mortgages and just a ton of like sort of conflicts and all that. So there's probably going to be USD CNY downside, and that's probably going to pull down risk assets, and that's going to have more of an influence on what would be largely a non-surprise, shocking, sort of revelations that come out of Jackson Hole. You're not going to get some sort of crazy thing that comes out of Jackson Hole. They're going to say we're concerned about inflation. Is that going to shock anyone if they say that? And if they say like, but we're also concerned about growth, is that really going to be shocking to anyone? Like, not necessarily. But like, forget about like what they say versus what they do. And if you just look at what like China's doing and just look at markets, period. Just look at like what market action is doing. It is following risk assets by and large are following USD CNY inverted. So just keep a very close eye on that as USD CNY continues to hit through these new levels ever higher, or CNY ever lower. And they are managed, again, this is a managed currency. They are allowing for this to happen. So keep an eye on that.
Good point. We get a bunch of questions on the European energy crisis, and I want to just comment briefly on it as the final remark of today's show. We have a question on Norway curbing electricity exports to the European Union as a consequence of the ongoing electricity crisis. I think that's obviously worth noting, since Norway is basically self-sufficient, and it could be one of sort of the countries of export that Europe could rely on in this case, but certainly on electricity, and they're not willing to. That's fair to say. And also, if you look at the pricing of Dutch gas, so the TTF contracts priced out of the Netherlands, I think the current market action is clearly a signal that liquidity is non-existent. We've heard that before. We also heard it that during the very latter part of Q4 last year, that the liquidity was non-existent in these contracts because everyone's just the same way right now. No one's willing to sort of sell gas with a future date outside of those sort of naturally inclined to. So it means that it's one-way traffic in these contracts, making no liquidity on the sell side. And therefore, basically, if we get just a glimpse of hope in this natural gas crisis, I think this market could turn around fairly quickly, as we've seen in other commodities. We also saw how the market just spiked like crazy in December last year before it went back to very low levels in January. So you should certainly be on the watch for a reversal of that gas trade in Europe as well. I don't necessarily think it's just around the corner, but if we look 3-4 months ahead, I think we will price natural gas at much lower levels. So those were my 2 cents on the European energy crisis. Weston, it will be interesting to watch the Jackson Hole later this week. Thank you for joining the debate today.
Thanks so much for having me. It's always a pleasure.
And as always, I'll conclude the show with a meme. And today's meme is, of course, a meme on the euro after we broke parity again versus the US dollar. So Toby Maguire now finally got his glasses on. It was not the Turkish lira breaking parity. It was the euro. I'm Andreas Steno. My colleague Maggie Lake will be back with more tomorrow with Darius Dale guesting the show. Thank you for watching the Real Vision Daily Briefing.